welcome to the Monday Futures Market Outlook for March 21st, 2011. This is Patrick Serezna. For those of you that have not had the opportunity to try out eMiniSource.com's trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. Does a very good job to depict the bull and bear market cycles that we've gone through. Back in 2010, we bullishly crossed above that 80-week moving average and have remained above so even during the consolidation during 2010. We were saying so long as it holds above the 1,000 level, we would be looking for that rally to make it up towards the 1350 to 1380 area on the upside. We currently have gone through just under a 10% market correction, about 5 to 8%. And as that correction has occurred, we certainly can't rule out the possibility that the market still has to follow a prolonged topping formation that may take even months to play out. But we were looking for that little correction, and now we more than likely may even come back to retest some of those previous highs. When we take a closer look at the S&P 500 on the daily charts using that E-mini futures contract, we had that correction come from top to bottom from 1340 basically down to 1240 in that corrective pattern. Really at this stage we find ourselves even this morning trading as high as the 1290 level. This is going to be a critical moment on Monday and Tuesday to determine whether or not the bulls will just simply have follow through on the upside, because as this rally is occurring here, if we reject off this level, we still cannot rule out the possibility that there is one more leg in this market correction downwards that could even see the 1200, 1220 area on the downside. And so that it's going to be critical to see how today and tomorrow trade and whether there's bullish follow through. If there is bullish follow through, then this correction may be already finished. And any break above 1300 on the upside would have us look for a retest of the previous highs, if not even push to a higher high, maybe 1350, 1380 on the upside. So again, the next few days are going to be very critical right around this very level where we're trading to determine whether or not there's one more leg lower or not. Just to review our key points, we maintain our intermediate bullish bias, though we have and do suspect that there will be a market top developing somewhere in this 1340, 1380 area if we haven't seen it already. More than likely we are going through a topping process which would have that market retest those zones on a number of occasions. And initially we were only anticipating a market correction and not a bear market to start here. So if this market correction really comes to an end somewhere in this zone, it'll be a short-term buying opportunity for a 4 to 6 week cycle. We're not bullish for the remainder of the year. We just simply believe that if this correction is done, there should be another surge higher to test some of those upper zones. Next year, I want to take a look at the NASDAQ 100. You can see that it's similarly has corrected the way that the S&P 500 has down to the previous highs back in November where that consolidation occurred. Again, we'll be watching that 2300 area on the upside. If the bulls can exceed that level on a really good push, it could put an end to that market correction. Anything that holds below there, we have to still be open to one more leg lower that could see 2100 on the downside of the NASDAQ. One way or another, we believe that we're getting closer to a market bottom here, and we just need to watch how it develops. Next year, I want to take a look at the U.S. dollar index futures. We continue to see deterioration in the U.S. dollar. We've been looking for lows in the U.S. dollar to potentially come in around the 76 to 74 level. So long as the U.S. dollar is weakening, we could see continued strength in commodities and certainly a base under the stock market. When we finally see a U.S. dollar bottom is when we're going to be looking for a much bigger rotation in the stock market. But so long as this U.S. dollar continues to deteriorate, then the trends that have been in place over the last 6 months can certainly continue. Next year, I want to take a look at copper futures, and when we look how copper is reversed off of that 410, 420 area, again, if that U.S. dollar is weakening and we have everything being stable, copper can work its way not only back to its previous highs, but maybe even make an attempt at the 480, 500 level where we had the highs of, or our targets for the highs for the year. So we certainly cannot rule out still one more push higher on copper. Next year, when we take a look at gold futures, we drew on the flagging formation and arrow where we're anticipating gold to go. Gold should be able to make this break. If we see a solid push above 1430 on the upside, then we'll be targeting moves up to 1480 and even as high as 1520, 1530. There are the higher targets on the upside are just measured moves, but we don't necessarily think gold will have that much strength to be able to make the higher targets. But a minimum of a $40 to $50 push higher towards 1480 is very realistic. Next year, I want to take a look at crude oil futures, and more or less, we had this little flagging formation. We continue to emphasize that 96, 97 support held very well last week and reversed off of that again. So long as U.S. dollar continues to deteriorate and the global situation creates uncertainty in Africa and things like that, we'll see crude oil make another bullish attempt. We could see 110, 115 on the next push. Finally, I want to take a look at the 30-year Treasury notes, and we had a nice little bullish push higher that was spurred on by the global situation and a really good auction. But nonetheless, we've seen a little bit of a reversal off those 30-year Treasuries on this period. Overall, if we see the existing trends in place continue, which is a strong commodity market, strong S&P 500 and a weakening U.S. dollar, then more than likely the 30-year Treasury notes are going to stay relatively range bound, head right back down towards their previous lows in a bottoming formation. So if we continue to see that deterioration in the dollar, I wouldn't be surprised if we see 120 or 119 on the downside of the 30-year Treasury notes. But overall, I'm not necessarily bearish, but simply don't anticipate a strong, robust rally in the 30-year Treasury notes without seeing some intermarket shifts going on in the dollar. That was your Monday Futures Market Outlook. Thank you for joining me.